All right, so this week pretty much erased everything that happened last week. It was kind of a crazy week that we finished up with here. A little bit more bullish by the end of the week than I thought we would have going into. I figured we'd start off okay, considering how much we kind of sold off last week. I didn't finish. I didn't think we'd finish as strong as we did, and we did, and it was very strong. So we got some pretty bullish signals, but there's also a couple of red flags because of how bullish it was. A couple of red flags popped up too. So I'm going to show you kind of the mix of those two, what I'd be watching for, what my expectations are, what I'm going to be watching for to see if those expectations change. Very specific things because of those red flags, and I'm going to show you. We're also going to talk about what's driving today's bounce or this week's bounce back. What drove a lot of this week's action, and then our trade idea is a good illustration of the types of trades I am willing to take in this kind of environment. Very similar to what I've shown you already early in this week. So let's go ahead and get started. Today is Friday, February the 5th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the S&P 500 first with the market forecast indicator. And you can see the intermediate line has now re-entered the upper reversal zone, showing a bullish posture, strong bullish posture. Of course, it's already been dark green shading because it turned up and it's already above 50, so we had that there. The near-term line also is up there, and the market sentiment line's up there. So it's not a traditional overbought cluster, which includes the three lines with the momentum line. And that's, the momentum line is actually more important than having the market sentiment up there. But still, you have 3 out of the 4 lines that are up in the upper reversal zone. Kind of shows how bullish we are, how strongly bullish we are. And that can be the case for a while, right? Because you can see the near-term line can actually stay in the reversal zone for a little bit longer than obviously the intermediate line can stay up there for a long time. The market sentiment line, once it gets up there, can stay up there for a while. But you can see periods where the near-term line can stay up there too for quite a period of time, whereas the momentum line goes up and basically enough to get a cluster, and then that's it. You can see, generally speaking, when you've got a strong bullish posture and the momentum line gets up to the upper reversal zone, you're getting a cluster. Not always the case, because we didn't get one over here. The momentum line came because we came off those strong lows there. The near-term line wasn't up high enough. But generally speaking, if the momentum line gets up to the upper reversal zone, generally, when you got a strong bullish posture, you typically don't get very strongly oversold momentum lines, and that's the case here. You do when you're in a bearish trend. See how when you're in a bearish trend, you get lots of really deeply oversold momentum drops. But when you're in a bullish trend, you obviously don't. So as soon as we get one of these kind of drops, then that's a sign. I mean, nothing's hard and fast, but that's a sign that a trend may be changing. Obviously, when you're in a bullish trend too, the near-term line rarely gets down in the reversal zone. You can kind of see it. This was about as close of an intermediate pullback as you got here without actually being one here in June, and you did get some pretty deep oversold momentum lines and the near-term line dropping there, but then not since. And then you had these periods with some oversold near-term lines, again, not since. So when you're looking for signs that that we might be entering a period of dark pink shading, or a period of light pink shading might not turn into a bullish bounce like this last one did, then look for the momentum line to drop below 5 and the near-term line to drop below in the reversal zone. And you notice we didn't get that here on this pullback. And last Friday we talked about we were just about on the cusp. I actually thought we would bounce up early in the week and then turn back down, and we didn't. We actually bounced up early in the week and kept going up, and have now gone up to a new strong near-term high point. So it looks like, again, we are already, 3 months? More than 3 months now, because this started on November the 5th. So we're at February the 5th now. This is February the 5th. So we're now 3 months into this intermediate run. We've had a couple of periods of light pink shading, one of them with the yellow line, and we'll see, whether we get, remember, 1 to 3 is your typical time frame. So now this last time we got 4 to 5 months, but that was because we're coming off a significant low point, and then we kind of went parabolic at the end. Actually, we went, let's see, it started here, the dark green shading started in middle of April, and we made it to, looks like almost the middle of September, so almost 5 months of that intermediate rally there. Almost 5 months of a strong bullish posture. And again, we didn't really have that deep of an exhale, so I just actually didn't think we'd get to 3, and we are at 3, going on the potential for 4, if not up to 5. So, and again, that was 5 months coming off a strong low and went parabolic at the end. We're not coming up off a strong low here. We're already at 3. What's it going to look like, and what's the exhale going to look like when we do finally get one? When we've gone even longer than normal. I mean, not even longer than what you would expect it here anyway, because I thought we'd only go about a month coming off of a shallow exhale, shallow pullback. But the fact that we went to the extent of a normal run, and now we're going on an abnormal run following a shallow exhale, which followed a very abnormal run there, which obviously followed a really deep low point, then that kind of shows, I wonder, that abnormal run led to a shallow exhale because we were coming off such a strong deep low. Here, we're getting an abnormal run off of a really not so deep low. What kind of exhale is that one going to look like? We'll just kind of keep our eyes on that and see. Remember, a pullback doesn't start until you break the 23% retracement. We were so close last Friday. In fact, we were there at the lows of the day when I was teaching my technical analysis class. Obviously didn't finish there, and that's the most important. And we were right on the cusp, and we came off of that cusp this week. And now, really 5 strong days to the upside. In fact, I saw something that said that this 4-day rally to finish at an all-time high is the strongest 4-day rally to close at an all-time high since March of 2000. And obviously, everyone looks at that as the start of the end of that particular bull market. And that doesn't necessarily mean that this is the start of the end, but it just kind of shows just how bullish we are. Like the kind of environment that would produce that strong of a 4-day rally to close at an all-time high, which generally, closes at all-time highs are generally grinding moves. They're typically really small. We're grinding to all-time highs. The fact that we bounced so hard, so fast off of what was pretty much ended up being a noisy move because it was right to the 23% retracement at the time. You can see here, let me activate this line. So you can see at the time here, we were right at the 23% retracement. So what ended up being a noisy move produced an environment where we got one of the strongest 4-day rally to close at an all-time high since March of 2000, which we already know was also a very bullish environment, kind of a mature bullish environment, and was the last time that CAPE ratio, that long-term PE ratio, was as high as it is. Let's take a look at the Russell 2000 here really quick. You can see the strong move that it's made. It's obviously going up to higher highs. Its near-term line hit practically the 100th percentile. In fact, when you round up, you notice over there on the left on the tag to 2 decimal places, it is the 100th percentile. So it's about as bullish as you can get in the short term. We haven't had that bullish. I mean, we were in the 97th percentile there. So this is the most bullish, the near-term line. I mean, 5 straight days. I mean, look at that strong rally coming off of last Friday's move. And then, of course, the NASDAQ 100, not so strong. Near-term line not as high, but still the same result nonetheless. This bullish intermediate confirmation signal that we got on Wednesday bounced up to a continued bullish pattern here. But again, we are 3 months along into this, and so at some point in time we'll get the type of pullback on a short-term basis, as I mentioned, where the momentum line drops to a much deeper level than we've seen, and the near-term line drops to a deeper level than we've seen. That will spark what could be the beginnings, like this example here, of a intermediate decline. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked our video today and that you want us to do another video again on Monday. It's a quick way to give us feedback. If you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, you can do it with one click right now. You can even do that right while you're watching. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have about anything I talk about? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. You get access to our Market Outlook forums on our website for free. So subscribe there. Follow me on Twitter for more content in between videos from day to day. There's my handle there at DavidSettle42, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website here, check out some of these other things over here on the right. In fact, this weekend Brandon updated our sector watch lists. He has a tutorial here on how to update those for our premium subscribers, as well as all of our charts and his factor selector that he uses in his Wednesday class. So check out some of those premium resources. Those go for all of our premium subscribers. Premium subscribers and our monthly subscribers actually all get access to our Market Outlook live video. So every day I do the Market Outlook. I do a live video on YouTube at 3:30 Eastern Time. I review all the trades that we've done recently that we're still managing, and we continue to manage them up until we close them. And we closed out a few again in Friday's video. So make sure you check that out there. And then come down here, click on this heart. That opens up a new tab where you can like the video there. You can also retweet it. Right here you can retweet it. If you click on this heart, or the hands, thumbs up icon, sorry, it also takes you to today's Market Outlook Facebook post. Click on that like button too. Again, the more you do that, the more of our followers will actually see it. You can see it's only reaching right now about 100 of our followers. We have well more than that follow our pages. So the more likes and engagements it has and shares on Facebook and Twitter, the more all of our followers will see our content. It benefits you too, because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's get back to the charts and let's take a look at what's going on here. You can see on this week's candle, back to another transition candle here, but next week's candle, you can see the open's going to be at the midpoint of the body, so right about 37.96 or so. But we're already trading at 38.86, so we're going to have a pretty decent size bullish body to start the week next week. Now, obviously, it will depend upon where we finish the week. But that's a pretty good bullish candle as it is. It would be a higher close already. And then now it's the question of whether or not we trade back below 37.96 to see if we get a lower shadow, and whether or not we pop back up above 38.94 next week to get a higher high, which would be your three things you look for a bullish candle to develop. And you can see over here at the end of the pre-COVID rally that we had, which was also ended up being about a 5-month long intermediate rally. Again, very abnormal to get these pretty much the last three intermediate runs have all been 5-month long runs. Or at least 4-month long intermediate runs. Very, very abnormal. But it kind of shows just how bullish things are. In fact, you can, not including this short one, but this one over here as well. We went from December, January, all the way up through April. Ended up being about 4 months there. And then over here from October all the way through to February, so about another 4-month rally. And then this 5-month longer. And now we're 3 months already. Very long intermediate runs. That's atypical. Again, 1 to 3 months. This is more typical, to get kind of a long one with a few short ones, and then maybe a long one to end it. Right. Well, here we've had a long one and a long one. Even if you broke this two up here with what was a very, very light intermediate, again, doesn't even, by definition, didn't count as one, but was about as close as you could get. You still had multiple long ones in there. So. But a pretty strong rally, and then we saw this over here at the end of that long one. We had a couple of transition candles there. The second one being a kind of a bullish candle that ended up the week after getting a bullish candle in February, and then we had our exhale, and it was already a pretty deep exhale before it really hit the fan when Saudi Arabia and Russia had their oil spat, right, and prices dropped like a rock, and yields dropped like a rock, and stock prices fell along with them. So I don't think we're going to get that kind, but like I said, we already had a pretty deep exhale already because of how bullish extremely bullish we were at the time, and we're even more bullish now than we were then. And again, the kind of transition that ended up not being a transition that led us into that deeper exhale. So yeah, pretty crazy couple of weeks, and that looks like next week will end up being, we'll at least finish as a pretty bullish week. This is what it looks like over here. That was the week that followed You had a couple of down weeks, ended up being only one here, and then we bounced back up and recovered the entire selling there, just like we did and more this week. So it looks like we follow that. We could follow that up with a couple kind of small weeks. We'll see what this ends up looking like. It's obviously we're not going to get another week with as big of a range, 170 points. So you'll probably end up getting a much smaller range, but it looks like there's precedent to follow up that significantly bullish range with another bullish candle, even if it's smaller. Let's take a look at the 3 green arrow chart. Obviously, you're back to 3 green arrows, 1, 2, 3, boom, 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 though on light volume, but still not even average volume actually. And then you look at the 2-line versions, and you can see you're back above the 8-day moving average, which is back above the 17. The histogram is rising. Whether or not we'll get a higher MACD remains to be seen. You wouldn't expect that we would, right? You'd expect that we're grinding down. So we'll kind of keep our eyes on the divergences that may be setting up here going into next week. How bullish we end up getting. You can see too, like from an RSI standpoint, we're getting lower highs. From a CCI standpoint, the possibility for lower highs. So, we're 5 days into a really strong rally. Whether or not it turns into 6 will tell us what those divergences end up looking like. Oh, one more divergence, sorry. The DMI, the positive index, you can see would also be a lower high, and then there would be a much higher low for the negative index. You can see if I go back out here to that pre-COVID high point, you can see very similar. After the ADX peaked, we got a lower high and a higher low on the positive and negative directional index. Again, after the ADX peaks. Here's the ADX peak on this one, and then after that we could be getting a lower high and what would be an obviously higher low on the negative. So very, very important week coming up to see whether or not we go for another month or two on this intermediate run that you can see here has ended, or whether or not we start seeing more signs of this exhale that's, you kind of see this little broadening formation forming, whether or not that means now that since we got a bigger move up here, if we'll follow that up with a bigger move down than what we even saw in the move that preceded this. And to kind of give you an idea of what I'm thinking, I would be in the camp of the former, that we'd continue for, potentially to February expiration, just kind of grinding a lot slower. But if I did see any combination of either a strong oversold momentum line and or an oversold near-term line, then we would change that. So as long as we stay, on these near-term pullbacks, very muted, as long as we stay obviously between 0 and 23, then we're fine. Obviously, if we broadened out even more to a lower low than where we got there, then we would obviously be breaking the 23%. So we would be forming a pullback. But as long as we stay muted, we stay between 0 and 23, we stay above the moving average, maybe flirt with it just a little bit. The near-term line stays above 20, the momentum line stays above 5, then we're fine. We're fine, and I would lean in the camp of extending this out. As we've seen, there's precedent for extending this out. All right, so let's take but I wouldn't be surprised if even as early as this next week that we get that kind of a sign on the market forecast, on the short-term lines. And if we did, then I would change my tune just that quickly, because that would be the sign that we were already on the cusp once here. We were already on the cusp of an intermediate pullback beginning. We weren't quite there, but if we got that kind of move, again, as early as next week with the volatility index confirming that, a move on the volatility index up to 105%, which we didn't quite get to there, then we'd say, okay, here we go, right? This is a little bit of a red flag too, which again makes me think that even as early as next week we might get that type of move. Obviously, we need a catalyst, and we'll see what that ends up being. But that near term, that the volatility to go from above 100% to down below 80%, which is extremely low for volatility, 80% relative to the 3-month VIX down here over here on the left, that is insanely fast to drop that far, that fast in 5 days to an extreme low. Because remember, when you get this extreme low, you typically bounce on volatility. And so that's a little bit of a concern for me. The fact that we didn't kind of grind our way and stair step our way down to where we had support at 95, to where we had support at 90, to where we had support at 85, where, for like a week or two, and then get to 80. Like, no, that didn't happen, right? Kind of like this. We kind of stair stepped our way down, progressively lower over the course of multiple weeks. We didn't go from here to here like we did just now. All right, so that, to get an extreme low suggests, man, as quick as we fell, because volatility typically pops faster than it drops, and out of nowhere. So that's a little bit of a red flag too to kind of keep an eye on. As you can see, the volume and volatility, or the trading range today was really, really small, or at least not today, Friday, sorry, yesterday. 2 points, the volume at 48 million. Those are pretty low numbers. 2 points, well below the average, almost half the average, which is relatively low. It's still kind of high, but still relatively low. The volume, 48 million, was well below the average. And we are easily above 1. So we are still in the mode where volatility can still occur and pick up. And as I mentioned to you with the volatility index, even though we dropped below 80%, like, we are only down to 21. Like, we've been down to 21 multiple times here. We've been down to 21 here, and we've been down to 21 over here. And none of these, only this other time in August did we get to 80%. But we stair-stepped our way down to that. And then that started our intermediate decline. When we were that low, that in September, that started our intermediate decline there. That peaked with it. So I don't think we would peak with a jump to 185% on our next intermediate decline. More often than not, we start the intermediate declines with that kind of jump. And if this is the kind of move that precedes it, I can totally see it starting with a pop just as quickly back to the upside. So, because that's not what volatility does. Volatility doesn't pop down and then grind up. It pops up and then grinds down. And the fact that we popped up and then like just fell like a heavy weight down, but still above 20, which means there's still concern and risk out there. Despite all the call buying that there is, there's still a lot of put buying. Then that tells you something, right? And that tells you just to be wary of the type of move that can start, like I said, because of how extremely low we already are, as early as next week. Look at the weekly here. You look at the weekly on this, and again, this is this. You can see how big and down that week was, and you can see again how big and low. Usually we get these big low candles and we finish up high, right? We finish at the 90% mark. We finish up here at the 105% mark. We finish at the 85% mark. You can see some pretty big candles. Over here it took a couple of weeks to get there. You can see some pretty big candles, big filled in candles where volatility drops sharply over a week, but never do you see it that big, drop that far, and finish the week at 80%. At an extreme low, as you can see if you go across here. When you're not in a strong bullish trend, because remember, we're not, right? Then it suggests that that we can just as easily just pop right back up. So be aware of that as early as next week. So to summarize that technical outlook, again, I think the odds of a short, of the intermediate decline and big volatility pop happening next week are low. I think it's a possibility, but I wouldn't expect it until I see that momentum line drop to an extreme low, to low 5, and the near term line drop to below 20. If we see that happen next week, all bets are off, right? Now the odds of that intermediate pullback beginning are very high. I don't expect it. I don't think it will happen, but I'm definitely watching for it because of the red flags that we see. I still think because we're in this kind of all or nothing type of market right now, where we either go up for 4 or 5 months on these abnormally long intermediate runs, or we drop like a rock, and we view noisy moves like this GameStop action as corrections. Even Tom Lee mentioned that this pullback we had on this GameStop stuff was a correction, and it was hardly a correction. It's just noise. But when people start calling moves like that corrections, then that means we are really kind of getting irrationally exuberant, and you can stay that way for. So that's why I say I kind of lean towards we'll probably get to that fourth or fifth month, at least probably the fourth month on the intermediate run. But I am closely watching again as early as next week for that type of move on the short-term sentiment on the market forecast line that would suggest, all right, here we go. It's not very high odds, but it's high enough that I'm paying attention very closely for it, and I'm definitely going to load up on bullish trades. From an active trading standpoint, as you'll see with today's trade idea, I'd rather try to stay as neutral as I can be as a result. All right, so let's take a look at what's driving the price action here, and you can see the week that was we're up almost 5% on the week on the S&P 500. You can see it was a combination. What started out initially this week as a move higher in all these NASDAQ names, QQQ, XLY, XLC. You can see energy had a move late in the day. So did materials had a move late in the day. And real estate also had a move late in the day. And then initially, look at energy really popping up on Tuesday. Financials had their big pop-up on Thursday and a little bit into Friday. And as a result, they both ended up pretty high too. Energy had that pop-up. It actually pulled down on Tuesday before popping back up Wednesday and continuing higher, which is good. We have one of our directional trades that we've done in the old on Market Outlook videos in that energy sector, and it's continuing to do well. The financial sector, you can see bouncing back up. The healthcare sector, which is interesting. If I go back and take a look at the prior, going back to the down week and then the bounce back up. So this is coming down. So we were down almost 4% and then bouncing back up almost 5%. You can see on the round trip, the S&P is up 1%. But look at what ended up doing well by the time all was said and done. Real estate ended up 3% throughout the 2-week period. Communication services obviously rallied more than it dropped, so ended up almost 4%. Everything else kind of matching the market here except for materials, which really came down and didn't bounce up nearly as much as energy did. You can see energy really dropped and really bounced up significantly to get back up to these levels. Was about, looks like about 1% or so there, kind of matching the market. But healthcare, you notice, kind of it went down and then it never really bounced back up. It ended up being down 1%. So you can kind of see, what the winners and the losers were. Financials and technology outperforming slightly. Utilities and staples were up 1% on the week. Industrials lagging behind because they never really bounced up as much. So it's interesting to see what went down so much and then what bounced up so much. Coming off of that Friday, kind of midday Friday low point there. So interesting moves, especially even in the U.S. dollar. If you take a look at the Euro U.S. dollar here, obviously for most of the week we had come down and finished Thursday with this oversold cluster where we had come into the retracement zone here. This reversal zone, right about 38%, getting down to the 50% retracement, but then bouncing, and the 23% retracement of the longer term move right off of this post-COVID low point here in May when the intermediate run started. So multiple intermediate runs on this kind of longer term rally, and you can see we got down to the 23% retracement, lining up with the 50 of the current intermediate rally. And then bouncing up on Friday here. Not enough to really reverse the intermediate trend, which is still strongly bearish, and we're still well below the moving average. Remember, you get your biggest bullish moves, at least on stocks, you get your biggest bullish moves when you're below the moving average, not when you're above it. Especially like when you're below the S&P gets its biggest moves when it's below the 200. The biggest bullish moves when it's below its 200-day moving average. So the same concept applies here. You're down a lot, you're making big moves, and now you're bouncing up. The question is how long that will last. And I don't think the dollar rally is done quite yet. This kind of pullback rally that it's having. Not any significant, not a long-term rally in the dollar. I still expect the dollar to be bearish in the long term. Just kind of more in the short to intermediate term, I think that it's having a little bit of a bullish run at least in some risk aversion in that particular, in the currencies market. You can see the yields are back up to their post-COVID highs. Right, we made one little run here immediately up to about 1.26, 1.25%, but then never, then we're not haven't gotten close yet or since, and now we are getting since we started this bullish rally the highest close up here. Looks like it just over almost at 1.25%. So bullish posture, dark green shading, green line. Again, if the dollar is going to stay bullish, the euro bearish, you will see eventually yields popping back as they would start to reconcile some of this bullish run that they've been in. And of course commodities too. You can see commodities really taking off this week up to new highs. Had a little bit of a divergence going there that now obviously we've busted on through. You can see where the Fibonacci lines are now, 23% down to 38. I mentioned before a divergence showing up on some of these oscillators. It's still there. It's even more significant because we're at so much higher high, but you're still there on the lower highs, and then also on the CCI being a lower high as well. Again, same concept, developing the divergences there in that particular asset class. All right, so we took a brief look. I did want to also take a look at the asset classes and how they performed in that same kind of 2-week turnaround period. We didn't take a look at that yet, but you can kind of see how initially, IWM, QQQ both fell, but you can see they both kind of came up about the same. IWM ended up finishing stronger on the week, but look at commodities really rising sharply. They've had a really good run here in the last 2 weeks, despite this kind of up and down roller coaster ride that we've had. On the other hand, you look at your safe haven asset classes over the 2-week period, both down about 2.5%, with the dollar being bullish. Again, over the up and down period. Initially was up during the pullback, and then was up some more during the bounce back. And just a little bit of a rally. And then, like I said, commodities were flat and finished last week, up a little bit. Obviously, way up versus equities, and they are still up versus equities. Just looking at this week alone, so now just the risk appetite move alone, small cap stocks up almost 8%, far outpacing what we're seeing in the Qs and the SPY, whereas commodities are matching what the market was doing. It's a pretty decent move for commodities in the short amount of time, and again suggests is reflective, especially with the rising yields, is reflective of the rising inflation expectations that we're seeing. That's, if you go to the 5-year, and this doesn't get a whole lot of publicity, but Charlie Bilello tweeted this out, and I'll highlight what he's talking about here. This 5-year break-even rate getting up to almost 2.25%, back up to 2013 levels. We haven't seen, and we haven't broken 2.25% really significantly since the financial crisis. So we'll see, if this really rapid pace of inflation expectations makes its way back up to 2.5 to maybe 2.75%, which is the range it had pre-financial crisis. Let's take a quick look at the charts at the 12 grid for those sectors. Here we go. Take a quick look at the 12 grid for the sectors. You can see all back to dark green shading and green line. There is a lot of pink shading here, and that's all since recovered. We've got dark green shading over here. We got dark green shading all across the board, and green lines. The only ones I'm not getting dark green shading on yet is staples. That's the one that's been lagging behind the most. Industrials has just barely turned light green. Materials still has a little bit of room to run. They're not green lines yet, but you can see how close they both are. So very, very broad rally across the sector rotation here recently. All right, so that brings us to our trade idea of the day, and I wanted to take a look at that healthcare sector, which you saw had, didn't really participate as much this week in the bounce back, so it's still kind of lagging in that 2-week period. If we take a look at one of the bellwethers that's been in the news here lately with the vaccine, and that's J&J, you can see we've had light pink shading after really kind of going parabolic here and close to getting a cluster, but a long upper shadow, kind of a shooting star pattern, and, after this kind of parabolic move, and then we made a run back to the moving average with light pink shading, almost got a yellow line. But nice little bounce back here, back to dark green shading and a green line. Just like that, and you can see as well, the bounce back got you back up to, back above the 17 and 8-day moving averages. The MACD histogram over there is rising. You can see the stochastics is looking like it's trying to turn up there. If you take a look at the long-term chart for J&J, you can see the transition candle, the long upper shadow, the transition candle we're getting now, the pretty high PPO relative to where it's been in the past. So you can see the potential for some weakness showing up historically in the stock at these levels. You can also see, you are bouncing back up, but we're in between the 100, negative 100 level. You're in between the 60 and 40 level here. If you look at the DMI, we're not getting a significant directional move anymore. The ADX is dropping as both the positive and the negative are relatively high. You look at the Ichimoku cloud, you can see we still actually have a pretty strong bullish trend going, but considering how things have weakened in the past, it's on the kind of the cusp of breaking that trend here if we were to stay weak over the next day or two. So we got some room to the upside to work with here on this stock. Some room to the upside to work with. But we also have some room to the downside to work with too, down to that value area and where the support is from a volume standpoint. So when I need or want room on both sides of the market to trade, then that usually sets me up for an iron condor spread like we did with Home Depot. But this case, I don't have a big, large volume node right in the middle of this range, but I have a strong support. It's a bullish trend. I have a strong support to the downside that I can use for one break even for, and I've got room to the upside to work with. It's the kind of setup we like to look at. So I do a bull put spread at the 20 deltas, do a bear call spread at 20 deltas. That means selling the 155 put, buying the 150 for protection, selling the 175 put, buying the 180 for protection. So when you look at it here, there's the setup. Looks like we got about 438 total across the 3 contracts. So position sizing normal because we just went through our earnings announcement for March expiration, with the idea that if we go up and or down, we can go in both directions by March expiration and stay around this area. It's a pretty wide range here that I can be able to make the maximum reward I'm shooting for. And knowing that out of the $1,000 of risk, which is normal risk for any position like this I'd want to do, I've got $438 worth that I'd be willing to lose. So I'd close out early if I got down to that level, down to that $438 level. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Again, remember, you get access to that with our free subscriptions, as well as all of our other subscribers get access to it too. But post any new threads in there, reply to other people's threads, and let's keep this conversation going about what we talked about in the video here, in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, like us on Twitter and Facebook too, comment on our videos. Have a great rest of your weekend. Go Chiefs. Have a great time with your Super Bowl parties, and we'll see everybody on Monday.